So Ray Dalio, the manager of the world's largest hedge fund, has said that he's lowering his odds of a predicted recession. Now, generally, I don't think there's a lot of value within these specific predictions themselves. However, I think we can gain some value and insight from the thought process behind them and an examination of history and past recessions. First off, thanks for your patience with these uploads. I'm working on a more regular schedule going forward in March, so you should expect to see more regular content coming out from the channel going forward. As a thank you for your patience, I've got a little reward at the end of the video, so you can stay tuned for that. And if you're new to the channel, consider subscribing for more investment content and analysis like this in the future. Back to the topic at hand, why has Ray Dalio decided that now he sees a recession as a less likely scenario? This is a stark change in tune from just a month ago, where he saw, quote, significant risk of a recession. Even going back to this time last year, he saw a 70% chance, in his words, of a recession by 2020. Now, the primary reason that Dalio has cited for a more optimistic view is the recent Federal Reserve pivot to a more accommodating posture. Now, he goes into more detail in this in a LinkedIn post, which is actually the source of these articles, where he outlines his initial thought process of what could potentially trigger the next recession. In this case, starting in around late 2017, Dalio suspected that the growth spurt that the economy was experiencing at that time would be only temporary in nature, and then the Federal Reserve's response to that would cause asset prices to fall and the economy to slow down. But as you know, in 2018, the financial markets experienced a lot of volatility, which appears to have affected the Fed's decisions going forward. This has caused the Federal Reserve to become more accommodative in their monetary policy, sort of reversing the normalization of what we've been seeing over the past 2 years or so. To get a visual example of this change of expectations in Federal Reserve policy, take a look at the following graph. What this chart is and represents is the market's best estimated probability of what the Federal Reserve's interest rates will be in December of 2019. Higher interest rates would be more of a normalization to rates we've seen in the past and would be indicative of a stronger economy. On the other hand, a lower expected future interest rate from the Federal Reserve would signal market expectations that the Federal Reserve was reacting to weakness in the economy. So if you look at the top of the graph over time, the highest color-coded line indicates what at that time is what the market views as what is the most likely interest rate at the end of December in 2019 at that moment in time. Now, from a period of around April to about September of 2018, this red line was on top, meaning that the market had the expectation that at the end of December 2019, interest rates would be roughly 2.5 to 2.75%. And for reference, the current effective federal funds rate is in purple, which is 2.25 to 2.5%. If you look at the period from mid-September to about mid-November of 2018, the gray line was actually on top, which would indicate that markets are expecting interest rates at the end of 2019 to be 2 rate hikes higher than they are today, roughly at 2.75 to 3%. Notice, however, that in December of 2018, that market sentiment completely shifted. Now you have the overwhelming majority of the market believing that interest rates are going to remain flat for the entire 2019, as indicated by the purple line for the probability of no more rate hikes this year being as high as above 80%. Additionally, which is probably as interesting, is that the second highest market probability is actually a rate decrease, which would be a complete reversal from the Federal Reserve's most recent policy of trying to increase interest rates to get back to a more normalized level. Not only that, but this year the Federal Reserve is planning to end the bond runoff of their balance sheet. The graph behind me is a chart of the Federal Reserve's total assets on their balance sheet. These assets are effectively U.S. Treasury securities and mortgage-backed securities that the Federal Reserve was buying to create more credit in the economy and to try and support asset prices by lowering interest rates. Prior to the financial crisis, these asset levels for the Federal Reserve were relatively steady at less than $1 trillion. However, in response to the financial crisis, the Federal Reserve has purchased over $3.5 trillion of bonds and mortgage-backed securities in an attempt to try and stabilize the markets. The bond runoff that I mentioned earlier was simply letting the maturing bonds expire and not repurchasing a new bond to take its place. This is a very gradual process, as you can see based on the very slow rundown of the balance sheet over the past year or so. The reason for the runoff is to try and get back to a more normalized balance sheet and interest rate scenario, because right now the Federal Reserve doesn't have many levers to pull to try and stabilize the next economic slowdown. However, the volatility seen in the financial markets during 2018 has appeared to spook the Fed, and they now appear to be ending this runoff. So getting back to Dalio's post, he said that the Fed's response is the primary reason why he's now lowered his recession probability from 70% now down to 35%. Now again, I don't think there's a lot of value with the specific percentages, but the key here is that in his mind, he believes that there's now less chance of a recession by 2020 than he had expected before. So the reason he's citing this is now the Fed can potentially lower interest rates by 2%, which they weren't able to do before when interest rates were at 0, to pick up QE, which is short for quantitative easing, which is effectively what the Federal Reserve did in buying all those treasuries and mortgage-backed securities from 2008 to 2014. Despite this, Dalio has said that he still remains worried about economic weakness coming at the same time as central banks' powers to reverse it are limited. So to put this into more of a historical perspective of what the Federal Reserve's monetary response has been prior to, during, and after recessions, I'd like to direct your attention to the graph behind me, which is the effective federal funds rate that the Federal Reserve sets as their interest rate policy. Now this chart goes back to 1955, and any gray sections in the chart indicate periods of an economic recession. Take a look at the pattern of the interest rates, specifically how interest rates changed prior, during, and after each of those gray bars. If you look closely, prior to every recession, the Federal Reserve has been in the policy of raising interest rates, and then as or near the recession occurs, it pauses those rate increases, and then during the recession, it reverses that policy completely, lowering interest rates until the recession is over. This pattern of interest rates by the Federal Reserve has occurred almost over every single recession that we've had over the past 50 plus years. But let's take a look at more recent modern history over the last 20 years, and specifically the interest rate moves prior to each of the last two recessions. In January 1999, the Federal Reserve was increasing interest rates up until around July 2000, at which point, based on the market's reaction, it had stopped increasing interest rates, and then by December 2000, it began a process of cutting the interest rate to the lowest it's been in over half a century. With interest rates then at record lows all the way through 2004, they finally began to try and normalize interest rates and increase rates all the way through August of 2006, before once again stopping any further interest rate hikes. And shortly after, we had the recession and the financial crisis, where the Federal Reserve response again was to drop interest rates dramatically and very quickly. The severity of the recession was so much that we had unprecedented Federal Reserve interest rate policy, pegging the interest rates at effectively 0 for over 7 years. Only in late 2015 did interest rates finally begin to rise, but it wasn't until December 2016 that we began our slow process of interest rate normalization. Notice that the slope or rate of increase of these interest rate hikes is much slower than compared to 2004 to 2006. Now let's go back to our graph over here, and what was the lesson we learned from this? What we learned from this is that the market currently today is expecting that interest rates from the Federal Reserve will be effectively unchanged through 2019. This is indicated by an over 80% probability that the December interest rate will be the same as today. So projecting forward, what this graph will potentially look like 10 months from today is that we'll be seeing a pattern of a rising interest rate from the Fed, followed by a leveling off. Again, a rising interest rate by the Fed, followed by a leveling off. If you look at what immediately preceded both of those processes, we had a recession. First in 2001, and then again in 2008. Also note that the peak of these interest rates has decreased each time, being the highest in 2000, was lower in 2007, and now will be much lower in 2019. This means that the Fed's ability to lower interest rates in the terms of a stimulative monetary policy will be much more limited than in past recessions. This is why I'm a bit skeptical that any Federal Reserve actions would be enough to prevent any type of economic slowdown from really becoming a recession. Based on history, it seems like those dominoes are already set in place. On the other hand, I can at least understand Dalio's perspective, in which the Fed, at least now today, has a little more breathing room with interest rates at least at 2%, compared to where they were from 2015 to 2008, with interest rates effectively at 0. It seems Dalio believes that this cushion is just enough in his mind to more gradually slow down the process of an economic slowdown. Regardless, no one exactly knows what the future will have in store and when exactly the next recession will occur. However, I think it can be valuable to be a student of history and to understand what circumstances occurred, at least regarding the Federal Reserve's actions, prior to these recessions, so we might have a better clues and insights as to generally when there's more elevated risk of recessions going forward. Right now, while I do agree with Dalio that there is more room for accommodative monetary policy at the Fed, at least compared to in the past, I'm not particularly confident that the Federal Reserve's actions of pivoting to a more accommodative monetary policy will have significant effect in preventing an overdue recession. Either way, I'm very curious to hear your thoughts in the comments below. Do you think we'll have a recession by 2020? And do you think the Fed really has any control over whether or not that will occur? And as a thank you for your patience as I'm building out my upload schedule, I'm excited to announce that I will be hosting office hours twice a week from 8 to 9 p.m. Eastern Time on Tuesdays and Thursdays. I have a private Discord set up just for this. The link is in the description for those on my email list, which is free to sign up. And this is a chance 2 times a week to ask any questions related to investing, stocks, or any other financial topics. I'll be fully available within the server for that hour to answer questions and chat with you about stocks and investing. Links in the description, check it out. It's free and an additional resource for you. Until next time, thank you so much for watching. My name's Michael, and I will see you in the next video.